When diving into commercial real estate, one number stands out above the rest: net operating income, or NOI. If you're serious about evaluating an investment, understanding NOI is crucial. It's the heartbeat of your property's financial performance. So, what exactly is NOI? Simply put, it's the income generated from a property after deducting all operating expenses from gross rental income. But remember, this calculation is done before accounting for debt service and taxes. The formula is straightforward. NOI equals gross operating income minus operating expenses. Now, why does NOI matter? First, it plays a pivotal role in property valuation. Investors and appraisers use NOI and cap rate calculations to determine how much a property is worth. The higher the NOI, the more valuable the property. Second, lenders look closely at NOI when underwriting loans. They want to ensure that the property can generate enough income to cover its expenses and debt obligations. This is especially true for debt service coverage ratio, or DSCR, loans. A solid NOI gives lenders confidence in your investment. And let's not forget about investor returns. NOI is a clear indicator of how much profit a property is actually generating. It tells you whether your investment is thriving or just surviving. Now, let's break down what's included in NOI. You'll want to consider rent from tenants, parking income, and even revenue from laundry or vending machines. These are all part of your gross operating income. On the flip side, you need to deduct operating expenses. This includes property management fees, maintenance and repairs, utilities if they're landlord paid, property insurance, and property taxes. It's important to note that mortgage payments, depreciation, capital expenditures, and income taxes are excluded from this calculation. To put this into perspective, let's look at a simple example. Imagine you own a small retail strip center. Your gross rental income is $150,000, and your operating expenses total $45,000. So, your NOI would be $150,000 minus $45,000, which gives you $105,000. That's a solid number to work with. Now, if you're looking to improve your NOI, there are several strategies you can implement. First, consider increasing rents without raising expenses. This can be a delicate balance, but if done right, it can significantly boost your income. Next, focus on reducing vacancy rates. A property that's fully leased is always more profitable. You can also cut operating costs by finding more efficient service providers or renegotiating contracts. Lastly, think about implementing ancillary revenue streams. This could be anything from paid parking to signage fees or even vending machines. These additional income sources can really enhance your bottom line. In conclusion, grasping the concept of NOI is essential for anyone involved in commercial real estate. Whether you're buying, selling, refinancing, or analyzing properties, investors who can read an income statement and identify the drivers of NOI have a distinct advantage in deal structuring and wealth building. If you're evaluating a CRE deal in Houston, Katy, or Fulls here, let's run the numbers together and see how we can maximize your investment potential.